All right, hello everyone again and welcome. My name is Elliot Gu and I'm the co-founder and chief strategist for Pig versus Bear. Welcome to our strategy session titled How to Trade the Final Phase of the Bull Market and Profit from the Coming Bear Cycle. I'm joined today on today's session by my good friend and fellow co-founder of Pig versus Bear, which is Roger Conrad. So hi, Roger.
Hey, Elliot.
Great to have you on. I know we had a couple of little technical difficulties there, but it sounds like all good now. We decided to host this call today for one very simple reason, which is that we believe that we're now entering a phase of the economic and market cycle that's absolutely tailor-made for the sort of short to intermediate term trading strategies we recommend in our Pig versus Bear service. So today, we really want to warn you about some of the major shifts we see currently underway in global markets, and that we think could actually have some really crucial and important implications for your portfolio. And we also want to show you some specific ideas, indicators, strategies, and some specific trades, mainly stocks, exchange traded funds, and options that we're currently recommending to profit from these shifts, again, in our Pig versus Bear service. Now, to be clear, I know the word trading carries a lot of negative connotation, but Pig versus Bear is not a day trading service. The majority of trades we recommend are open for weeks, not days, and certainly not hours. Our research confirms that the coming late cycle phase of the bull market, which we've been talking a lot about lately in Pig versus Bear, and we're going to talk about a lot today, will be very, very profitable for those willing to profit from those shorter term trends and trades. And that means moving from sector to sector, ETF to ETF, and stock to stock. In contrast, it could be a devastating time for the sort of buy and hold, passive index-like strategies and approaches that worked so well last year, where we had a very unusual, no volatility type of marketplace. In fact, that's what really convinced us that we're entering the late stage of this bull market and that we needed to have this webinar today. That stock market correction that started on January 26th. Those of you who have been watching the market today know that we're seeing another dip today. This is the first correction we've seen of 5% or more for the broader market since 2016. That again is highly, highly, highly unusual. Going back to 1937, the US market has pulled back 5% or more, an average of 3 times every year. And it's pulled back 10% or more, an average of once per year. So last year's no volatility, no correction marketplace, highly unusual. Before we get started on all this, and we do have a lot of ground to cover today, I just wanted to cover a couple of brief housekeeping notes. First of all, this session is being recorded. A lot of people ask me that. It is being recorded. And we will send out a link to the recorded version, including both our prepared remarks, as well as the question and answer session that follows shortly after, as soon as it's available. And that's likely to be, honestly, probably tomorrow at some point. We will send you a link to that. So if you have to leave early, don't worry. We'll cover all the questions and everything that if you want to post those, and we'll have a link to the recording to you so you can listen to it at your convenience. Second, as I suggested, following our prepared remarks, we'll take all the questions from you, the strategy session attendees. You can ask a question at any time during this session by using the chat function on your screen or the Q&A function that you see on your screen. I see someone's actually already posted a question. We will answer as many questions as we possibly can following our prepared remarks. Historically, we've gotten through all the questions asked by attendees on these calls. The third thing I wanted to say is that I know many of you on the call today are already subscribers to one, or in many cases, more than one of our services, including things like Energy and Income Advisor, or Roger's Conrad's Utility Investor. Now, of course, I know that I'm going to be discussing energy some today, and I know that Roger's going to be talking a little bit about utilities and some of the things he covers in Conrad's Utility Investor, but mainly as it pertains to Pig versus Bear and these shorter term trading strategies. Please understand though that not everyone on the webinar today, not everyone on today's strategy session is a member of, for example, Energy and Income Advisor. So if you ask us about a specific stock or recommendation in Energy and Income Advisor, we may not be able to answer that today. We've had some complaints in the past when we've gone on to talk about several different energy and income advisor picks and recommendations. And then, non-subscribers are hearing that information too. We've had complaints from subscribers. Obviously it's not fair if we give away or discuss our entire portfolio in energy and income advisor on today's call that's open to those that are not readers. Of course, though, we will endeavor to answer as many questions as possible, as specifically as possible. And if you're a reader to one of our other services like EIA or Conrad's Utility Investor, you can always send a question via email by emailing our service address. Now, some of what we're covering today is covered on the website you see on your screen. That's the pigversusbear.com 2018 Volatility Smile webpage. Don't worry, I will put it up a little later on in today's presentation. However, please note that not everything that we're covering on today's webinar will be on that website, and it's not posted on any other website we currently have. So with that, let me go ahead and get started with our quick agenda, or maybe looking at this page, our not so quick agenda. Because as you can see, we've set a pretty aggressive agenda. Not that unusual for those of you who know me and Roger, but the long and short of it is that today we'd like to tell you a little bit more about what we're seeing right now in global markets, some specific indicators we're watching, and some specific trades we currently recommend. Both stock, ETF, options trades, all of it. We're going to cover all of it a little bit today. And in a lot of cases, these are trades we actually currently have in the service, so you can get a flavor for the types of things that we're looking to play right now. We're going to be throwing a ton of information at you today, and we're going to have to move fairly quickly to stay on schedule and get to all the questions. We don't want to keep you here for 2 hours. And if you're interested in more, we have, however, decided to offer a special limited time risk-free trial membership to Pig versus Bear. Now that's available only to those of you on the call today. We're not offering it to everyone. And I got to tell you, it's by far the best trial offer we've ever had. And the reason we're doing that is because we believe the opportunities are greater today than at any time since we launched the Pig versus Bear service to beta testers 3 years ago. Now, Roger and I are each going to host a portion of today's call, and we'll kind of be passing the virtual mic back and forth, if you will, as we move through the presentation. But just in brief, as you can see on this agenda page, we're going to talk about why we think the recent market pullback is not the top of the bull market. The January 26 highs aren't the top of the bull market, how we're trading that recovery right now. The kind of selling we're seeing today and over the last couple of days is normal as you recover from a correction low. We're going to look at 3 simple indicators you can start using immediately to spot the real bull market top when it comes. We do think we're entering the later stages of this bull market, which means that within 12 to 18 months, hard to know exactly when, most of the opportunities from a trading perspective are going to be on the short side of the market. And we're going to talk a little bit more about that. In other words, betting on the decline in many stocks. We're going to talk about my favorite market sector to buy right now and exactly how we're trading it, in this case using options. We're also going to cover a simple rolling up option strategy. If you don't have experience with options, that's not a problem. In Pig versus Bear, we do both stock and options trades, or stock ETF and options trades. When we recommend an option, a call or put option, either long or short to play a trend, if it's at all humanly possible, we'll offer an ETF or stock alternative to that option, and vice versa. In other words, if we recommend a stock or ETF, we'll offer an options alternative for those of you who prefer to trade options. Reader surveys suggest to us that about half of you prefer to trade options, and about half of you prefer to trade only exchange traded funds or stocks, half of those in the service. So we do offer both types. But this strategy is specific to options, and I want to show you how we use it to generate some pretty impressive gains, a gain of up to 143% over just the last couple of months in an ETF that's actually down since we originally recommended it. But using this strategy, we turned just a volatile market period for, in this case, the Alerian MLPs into a profitable trade, very profitable trade. We'll also discuss how we use exchange traded funds or ETFs to trade the big moves in commodities. We've traded a lot in oil over the last 3 years. The stock market, S&P, also the NASDAQ, and others. Bonds, we've traded gold, we've traded all of those things. And you can, thanks to the advent of all these ETFs out there over the last few years, you can trade all these trends, which were previously pretty much unavailable to stock investors, those of us who have just a normal brokerage account. And you can do it all without sitting in front of your computer screen all day or trying to day trade or hour-to-hour moves. We're going to discuss how the rising interest rate environment is creating a once-a-cycle bullish and bearish trading opportunities in some of the most unlikely market sectors. I know Roger's going to talk a lot about that. A low-risk option strategy we're using to cash in on February's volatility spike in some of the safest stocks around. And of course, Roger's favorite short sale, a commodity manufacturer that's kind of masquerading as a tech stock, showing falling sales, operating in an industry with cutthroat competition, and the stock is absolutely priced for perfection, and Roger has an idea how to trade that. We're going to talk about, and finally, of course, as I mentioned before, we're going to open it up for your questions and answers. One more time, for those of you who might have been a little late coming on, this entire conference is being recorded, and you can ask questions at any time using the chat function on your screen or the Q&A function on your screen. We will answer as many of those questions as humanly possible following today's prepared remarks on the webinar. So I'll get started with the first couple of agenda items here, which is some of the market indicators we're looking at to time the cycle here, to determine where we are in the market and economic cycle and how to trade it appropriately. And in particular, whether some of the indicators we look at that tell us that the market top we saw on January 26 was not the top of the bull market, and that the market likely will see new all-time highs over the next 1 to 2 months. The first thing, we have a total of 10 indicators that we watch in Pig versus Bear and some of our other services, our 10 bear market signposts. I'm not going to discuss all of them today because then this conference there'd be no way we could get through it in even 2 or 3 hours. But I want to talk about some of the highlights there. First up, historically, and I'm talking about the last 12 market cycles, the last 12 bull markets and bear markets going back to the 1930s. 10 of the last 12 bear markets have started, the top of the market has come before or coincident with a US economic downturn or recession. So the economic and market cycles aren't the same because the stock market normally leads the economy. It tops out before the US goes into recession and bottoms out before the US recovers. But they are definitely related. And 10 of the 12 past bear markets in US history occurred right before or coincident with the US economic downturn. And that includes most of the most severe downturns. There have only been 2 in history, bear markets without a recession. They are 1987 and 1966. There are literally thousands of economic indicators released worldwide pretty much every single trading week. In the US, there are dozens, both released by the government, private industry groups, etc. You can get lost in that if you try to follow all those pet indicators or all those indicators that are out there. One of my favorites gives you kind of a quick and dirty read on the economy and has a long track record of success. It's been around since the 50s, is the Conference Board's Leading Economic Index, or LEI. It's published by the Conference Board, which is, and you can actually get it for free on the internet at conferenceboard.org. The LEI is a summation of 10 different widely watched economic indicators covering everything from the labor market to the stock market to trends in the bond market. And it's released every month, usually right around the 20th of the month. You can find the schedule again at conferenceboard.org, O-R-G. And what I like to look for here, the pattern I like to look for is I like to look at the month over month change in LEI. And what I'm looking for here, and this is just a quick and simple rule of thumb that has a great track record of success. Look at the last 6 months of LEI readings, the month over month percentage change in LEI over the last 6 months. If 3 or more of the last 6 monthly readings are 0 or negative numbers, so not positive, but 0 or negative numbers, historically, the odds of a US economic downturn within the next 12 months are elevated, meaning it's not always preceded a recession, but it's often preceded a recession within 12 months. The times that it hasn't preceded a recession, it has still often preceded a soft patch for the US economy that's resulted in a big stock market correction. So very important thing to watch. Here's an example from the last cycle. This is the LEI month-over-month change from 2005 through early 2008. The stock market topped out, as measured by the S&P 500 anyway, topped out in October, actually on October 9th of 2007. This indicator actually flashed high risk of recession the prior summer. I'm talking about the summer of 2006. So this gave you a very early warning signal that the stock market was at high risk of entering a downturn. And you can see how it worked there. In mid-2006, there were a string of negative readings on the month-over-month change in LEI. Very good signal that the US economy was headed for recession. This indicator has never not flashed red on this basis, and the US, in other words, we've never seen a recession without this indicator flashing red on the basis I just outlined. Here's the current look at LEI from 2012 up to the present month. The most recent month released from them was February. And what you can see here is, is January, which was released last month, at the end of last month. And what you can see is we haven't had a negative reading on LEI since 2016. So certainly not three out of the last 6 readings being negative. In fact, you can kind of see how there was an obvious soft patch for the US economy in late 2015 and early 2016. But that since then, since the middle of 2016, let's call it, we've been gradually seeing strengthening in these numbers. The month-over-month change has been getting higher and higher. That's typically what you see when the US economy is accelerating, not decelerating. So we think a recession over the next 12 months, at the current time, highly unlikely. And therefore, that's one major indicator you have that the top in the market on January 26 is not the top of the long bull market that started back in 2009. This is another indicator that has use as both a long-term bear market indicator and also an indicator of very severe pullbacks in the market that don't quite meet that traditional bear market definition of a 20% pullback from closing high to closing low, but nasty corrections, if you will, not outright bear markets. It has a good it has a good track record of that as well. It's market breadth. You might have heard this word. It's a technical indicator. And I'm using here the cumulative advanced decline line for stocks, not closed-end funds or exchange-traded funds, stocks traded on the New York Stock Exchange, the NYSE. This indicator, pretty simple calculation. Every day, we find the number of stocks advancing on the NYSE, and we subtract the number of stocks declining on the NYSE, and we add it to the prior day's running total. So we're keeping a running total. Simply put, when the number is going up, it typically means that we're seeing more stocks advancing than declining over time. Now, the S&P 500 is a capitalization weighted index, so it's very possible, we've seen it many times in the past, where the stock market keeps going up, but that rally is powered by just a few of the larger issues in the market. You know, the Apples of the world can push up the S&P 500 even if most stocks are declining because they have such a high index weight. Historically, important tops for the market, both bull market tops as well as the highs before a major correction, are preceded by a weakening in market breadth, which means that they get thinner and thinner and thinner as the market rallies. So the stock market keeps going up, but the number of stocks advancing that are pushing the market higher starts to decline. And what I like to look for is basically a divergence and trends in the breadth indicator. And I'm showing it to you here between 2013 and the end of last year. And I want to highlight in particular the middle of this chart. In other words, the 2015 sort of area on the chart. And I'll try to highlight it here so you can see what I'm talking about in red, this area of the chart. And you can see that in mid-2015, breadth hit a new all-time high. And then it sold off into the late summer of 2015. Then it rallied again, but it never got back up to that early 2015 high in breadth. Then it sold off again into early 2016. So we saw an instance where market breadth began to make a series of lower highs and lower lows from, let's call it the spring of 2015 to January, February of 2016. So that was a very clear indication of weakening breadth on the basis that I look at. Let me move over and show you what that meant for the market as a whole here on the next slide. And you can see it writ large here again, and I'll highlight it for you. Remember, I mentioned that breadth hit an all-time high in the first half of 2015. That would be this area on my chart. You can see it right there. Then over the summer, if you remember back, breadth began to decline. So even as the market was pretty much hanging in there here, where I'm circling, breadth had already begun to decline. We got this big sell-off in August of 2015. It bounced a little bit into September and then sold off again in the spring. But if you remember, through all that, breadth kind of kept declining. We got one more rally into November, December of 2015, which you can see here. We didn't quite get back up to the early 2015 highs, but we were kind of right there. But throughout this entire time, as I showed you on that prior slide, market breadth was declining. And that forecast to you that we were going to get at least one more sell-off in the market, the broader stock market, into early January and February of 2016. This correction from high to low was over 19%, so it was barely not a bull market. The fact, though, is today, the market breadth indicator, the advanced decline line, hit a new all-time high on January 26. Breadth has actually been very, very strong through this entire advance. Typically, you don't see strong breadth heading into a bear market. In fact, going back as far as I could with the advanced decline line, I could not find a single instance of a bull market top that did not show declining breadth heading into that bull market top. We're not seeing that now. So that leads me to believe that this is not a bull market top. The third market indicator I want to talk to you about today, the first was LEI, the second was the market breadth, the third is, and this is a key thing to just keep in mind, both from a trading perspective and from an investing perspective. The frequency and severity of market corrections tends to increase towards the end of a bull market. So bull markets don't die placidly. They don't die after a prolonged period of very low volatility, such as we saw last year. They die in a series of nasty corrections. I couldn't find an example in market history in the US stock market going back to the 19th century where we did not see at least 5% correction in the 12 months leading up to a market top. Typically, it's 3 or more. And you can certainly see that in the 1991 or 1990 to 2000 advance, the longest bull market in US history. You can see right there towards the bottom of this table that we had in 1998 and 1999 and 2000, we actually had a series of nasty corrections. So you can see them here ranging from basically 5% all the way up to 12%, all the way up to 19% correction in late 1998. That's typical of a bull market top. You tend to see a bunch of nasty corrections as you near the top of the bull market and enter a bear market. Now, it's no coincidence that we have just seen a 10% pullback in the S&P 500 since the January 26 high. We do believe that may be the beginning of this final volatile stage of the bull market, but it's important to remember that that final stage of the bull market can last anywhere from 8-9 months all the way out to as long as 2 years. So what we're likely to see, we believe going forward, is new highs for the market over the next year or so, and we believe the new high will actually come over the next couple of months, but you're also likely to see much more volatility than what you saw last year, and a lot of nastier corrections in the stock market than what investors have become used to over the last couple of years. In short, that's great news if you're a trader because you can jump in and out of market sectors. You can jump in and out of stocks. You can play stocks going up, and you can play stocks going down. It's not so great news if you're an investor, because you have to be very, very selective about the stocks you buy, and you're not going to get this sort of rising tide tailwind that we saw last year. And we think that you're going to see a lot of pain out there over the next 12 to 24 months, over the next year or two, because a lot of investors have moved to passive investment strategies, owning exchange-traded funds and the like, rather than picking stocks and sectors. And that's the strategy that does worst at this stage of the cycle, because those corrections are very tough to hold through. And so we think that it's definitely becoming a very good market for traders. And most important of all, we do not yet see a top in the U.S. stock market. And in fact, we're playing that. Here's a quick slide. I won't go through this all, showing you that that the last correction we had in this cycle, this is the current cycle, was from May of 2015, that lasted all the way up until July of 2016. It was a long correction, and it was a nasty correction of 14%. But we saw no corrections after the middle of 2016 all the way up until the most recent downturn. Typically, a period of placid volatility like that does not follow a bull market top, but it does follow the final stage of the bull market. And that's, again, where we think we are right now. How are we trading this? In pig versus bear right now, we are buying SSO, which are the ProShares Ultra S&P 500 ETF. This is an exchange traded fund. It's extremely liquid, trades 1.5, 2 million units a day. Again, the symbol is SSO. And here's what this ETF does. For every 1% increase in the S&P 500, this ETF is designed to go up by 2%. We believe that the market will make new highs this spring over the next month or two, which would mean rallying above that January 26 high on this ETF of around 125.72. We actually think this can get up towards 130 region. Those orange arrows you see on your screen are the dates that we entered this trade. In pig versus bear, we're big believers in scaling into positions. In other words, let's say that we want to put, let's just say as a number, as a dollar number, let's say you want to put $5,000 into a trade, into something like SSO, or let's just call it $6,000 to make it easier. Instead of putting in $6,000 on the first trade, we'd rather put in $2,000 to start, to give us a little bit of exposure in case the market just turns and goes straight up. As you can see, we did that in early February. We bought some right around 105. The market rallied a little bit, but then it sold off again to that February 9th low, and we picked up a little bit more. But because we had only a small position to start, we weren't hurt too badly by the fact that SSO broke down a little bit and hit down under $100 actually for a bit. We got our second tranche right over 100, and then we picked up a little bit more, up around 112 or so. So we've gradually scaled into this position over time. If the market dips a little bit more, we're actually considering adding another piece to this trade. And our goal, as I said, is for new highs over 125. So that illustrates what we're trading, why we're trading it, and how we got into it. With that, I want to turn the floor over to my good friend, Roger Conrad, who's going to tell you a little bit about income investing in this current late cycle bull market.
Thanks, Elliot. So the first slide here is basically the last time the Federal Reserve, before this cycle, the last time they started raising interest rates. And that includes that's primarily what I'm talking about is the Fed funds rate. So this starts from the middle part of 2004, and when the Fed funds rate was about 1%, and takes it all the way through to when they stopped raising rates, which was with the Fed funds rate at 5.25. Somewhat similar to what I believe the Fed is trying to push towards. Obviously, that's going to be affected by numerous other things. You know, a stock market, a severe stock market correction can interrupt them in this push toward normalized, what they would call normalized interest rates. That's one thing. Obviously, faster inflation, if we started to see some more indication of commodity price inflation taking off or wage price inflation taking off more than they expected, then we could see them move actually faster than what they've been talking about, which is basically 3 incremental increases this year, possibly 4. Of course, we have a new Fed chairman, so there's always the possibility things will be done somewhat differently, but that seems to be the direction things are going. The reason I put this graph up there is just to show you actual returns on certain stock groups that are traditionally considered to be very much at risk when the Fed is raising interest rates. One being the utility index. And if you take a look at this graph, you can see there are different colored lines. The white line is the Dow Jones Utility Index. The brown line is the S&P. And then something black line, which is or closer to that, very similar to that, is the Bloomberg North American REIT Index, Real Estate Investment Trust, also considered to be very interest rate sensitive. And then the green line is the Alerian MLP Index. And these are rolling total return graphs. So if you look at the beginning date, which again, the top there would be the April 30th, so the beginning of May of 2004, and then that's the start date. Everything starts at point 0, and then as a line goes up over that in the preceding weeks and months, that indicates the rolling total return. So you get to the end there of this period, and you can see that the Dow Jones Utility Index in this period where the Fed was raising rates, Fed funds rate from 1 to 5.25. Over that period, the utility index almost rose by almost 50%. The total return, which of course includes dividends, was a little over 60%. The REIT index actually did even better in terms of total return, about 64% return. The MLP index also did very, very well, close to 30% total return close to 50% total return, with a price gain of close to 30%. And all of those 3 big dividend paying indexes beat the S&P over that time, which was up about 15%, total return about 20%. And this was at a time, again, where the Fed was raising rates. Now, the fifth line there is the TNX. It's in red. And that is the yield on the 10-year Treasury note. So that's considered to be a benchmark index that other particularly bonds, kind of key off of. So when the 10-year Treasury yield is rising, which, as you can see, it was falling for a good bit of this time, actually, despite what the Fed was doing. But by the end, it was on higher ground than it was when the Fed started the rate cycle. You can see that this was a time of rising benchmark rates as well as a rising federal funds rate. And over that time, all these dividend paying stock groups actually managed pretty strong total returns. Well, what does that tell us? Well, it tells us that it's not necessarily a tightening Fed that affects these dividend paying stock groups. In fact, they can rally pretty robustly at a time when rates are rising. Rather, it's what's going on in the broad economy. And so all these stock groups, if you look at these sort of longer periods, even though people do sell them and you have some pretty volatile days when people are worried about interest rate trends, they do tend to, as long as the economy is going well, they tend to come out of those dips. And that's very important to remember at this point in time. Again, it's not so much, again, what the Fed is doing and whether the Fed is raising rates, it's that is the impact of that on the economy and the broad stock market. Over this period of time, it wasn't the greatest period of time for the S&P, but the S&P was very positive, over 10%, or roughly a little over 10% a year, I guess, in terms of total return. So, a decent period, but a very good period for all these other stock groups that are considered to be rate sensitive. So that's something of a disconnect, I think, that really does present pretty solid opportunities. Now, volatility has been increased in a number of stock groups, not just because, in the context of this rising Fed environment, in large part because so much of these sectors are right now owned by exchange traded funds, and more specifically, they're controlled by algorithmic and quantitative strategies that employ these ETFs. So that translates to a lot more trading than we've seen in some of these names that a lot of people just simply lock away for dividends. Certainly individuals who buy a utility stock in the Dow Utility Average, say Southern Company or Dominion Resources, they're in there to buy and hold and collect a pretty nice dividend check, but also enjoy the increase in dividends over time. And this industry, particularly when you're talking about companies like that, they've actually accelerated their dividend growth over the last few years. So even more incentive to hold. But when you talk about these stocks as they're held by ETFs and so on, there really is not that incentive to continue to hold. In fact, what's going to determine whether they're bought or sold is how many dollars are going into these various accounts that are controlled by these strategies. And when more dollars go in to these strategies, that creates what's in effect a constant bid on these stocks. And we saw that certainly over long periods of last year when utilities, REITs, and so on kept climbing to higher and higher highs and well above historical measures of valuation. So we were in territory that we'd never seen before in terms of high PEs, high dividend yields, and so forth. And again, the reason is just simply that there's more dollars, funds flow, going into these ETFs that are controlled by these strategies. So what happens on the way up happens doubly, they say, on the way down. And so since the middle part of November, so a couple months before the broad stock market started heading down, you started to see a lot of selling of these dividend-paying names. And a lot of that had to do with, I guess, concerns about the tax reform, concerns about inflation, concerns about interest rates, and so forth. Even though not a whole lot had changed, but that was enough of an impetus for these groups to underperform, and in other words, be even more volatile on the downside than the S&P has been since this market correction. So therein lies our opportunity, in my opinion. So taking a look at the next slide here, I believe that that history doesn't repeat, but it often rhymes in the market. And one of the years that, at least as far as dividend-paying stocks are concerned, that seems to match up at least somewhat to what we're seeing now in the market is 1987. There you started seeing, this graph shows the Dow Jones Utility Average again. There are other utility stock averages, but the Dow Utility Average really does give us the longest term context because it's been around the longest. So I think actually right now the performance of utilities is probably better measured by larger indexes like the S&P subsector index, which has roughly twice as many names as the Dow Jones Utility Average. So it's more representative. Or some of the other indexes behind the ETFs that are traded for utilities, one of which I'm going to talk about here in just a minute. But the Dow Utility Average is very instructive in giving us kind of a long-term perspective on and going back into previous years where these other indexes didn't exist. And so therefore, looking here at 1987, I think we can really see a lot of perhaps an emerging pattern. We started out the year in January, big upturn for the utilities, and that was continuing on to gains that we'd seen the two previous years. But at that point, people started talking a little bit more about inflation, a little bit more about interest rates. And we were pretty close at that point psychologically to those high inflation days of the 70s, and particularly the spike that we saw in interest rates and gold prices back in 1980. So a lot of people were talking about a repeat there. This was pretty early in my career. in this business. And, you know, that it was pretty exciting for a number of things. One area that, in fact, we're getting involved with now in PVB, not going to give too much away here, but it is actually gold. And we have a pretty successful trade going on that now that we entered not so long ago. But this was also, 1987 was also a pretty good time for gold. I don't know how many of you remember the days of the penny gold stocks, where you had literally companies that were created out of the ether. The old saying was that, you know, a penny mining stock or a mine is a hole in the ground with a liar at the bottom. Certainly, there was a lot of excitement there. A lot of people made money, and it ended badly with the correction in October. There was Black Monday for stocks, but also Black Tuesday followed for gold mining stocks. So that was sort of the air let out of the balloon of that. But we did have a pretty profound period of volatility for gold stocks, also for utilities. And this is what this is showing you here. A lot of ups and downs after that initial rally in January. Big sell-off in the spring, which then led to a big spike up into May. Another down leg in June, a big spike up in the middle of the summer, or some middling action, and then finally that big, huge plunge you saw into into October. And again, once again, proving the point that utilities are stocks and follow the stock market. This was a time when there was a lot of downside bias because of the worries about interest rates and inflation. And of course, we're nowhere close to those types of levels, but perhaps we are psychologically, we are pretty far away from that period, 1987. We're 31 years later, as a matter of fact. But there's definitely been a lot of excitement, spike up in rates. And even though, as I pointed out, utilities can rally in times of Fed tightening, I could show you another graph showing that utilities have often rallied in other periods of Fed tightening, as well as the current one that I would reckon began in May of 2013, when the Fed announced they were reversing quantitative easing, but certainly beginning in December of 2015, when we saw the Fed raise for the first time. It's actually been a pretty positive period for holding this sector. But now we've moved into this last period, as Elliot discussed, where the stock market's more volatile and people are looking for more reasons to sell. And we've certainly seen that in this earnings season, where so many companies have reported really strong numbers, beating their guidance in many cases, but actually either selling off or running in place in the face of the news. Or if they did make a nice gain, they gave it up. Again, more volatility, and I think this graph showing kind of a similar situation when the market was generally going up over this period to that decline. Utilities started selling off first. And that was a prolonged period of volatility for that sector, and it gave a lot of opportunities to go on both sides. So this is really what we're talking about here with pig versus bear. It's different from our other services. If you're a reader of Conrad's Utility Investor, you know that we've had a pretty defensive overall posture for many months now, and that drawing out of those very high valuations that we saw. My opinion has been that those high valuations represent extremely high expectations that can be punctured, and when they are, the air runs out very quickly. So whereas it took a long time for some of these stocks to go higher, it won't take very much time once the bubble is pricked for the air to come out and for them to come down in a very big hurry. So we've been pretty defensive there. We've done things like recommend taking profits in even some of the names that we really liked when they got to those very high valuations, taking at least a partial profit, in some cases a full profit. We've recommended things like just particularly selling out of weak companies, accumulating cash for a better buying opportunity, buying only when certain buy targets were reached. and also accumulating hedge positions or a hedge position in an ETF that would go up as prices have come down. So those are the types of steps we take there in our long-term services, protecting ourselves, protecting our gains, and generally trying to get positioned for those lower prices that accompany a sell-off. You know, it's hard to say right now how much lower things go. We're already down about 15-20% in many of these stocks from the middle part of November. So we may be pretty close to the ultimate low, but we're going to see as long as this stock market avoids a big correction, we're going to see a lot of ups and downs along the way. So that's what we try to play in pig versus bear, playing on that volatility. And the next slide here basically is the trade that we've had on for a few months now. We have added to this position, and this is another thing we do in pig versus bear when we want to make a big bet on something. In this case, again, in fact, utilities have been very expensive and are very vulnerable to a puncturing of their expectations from any number of things, from worries about interest rates to bad earnings reports, to even kind of random events such as the fires in California that have really taken the wind out of the sails of the big California utilities, particularly PG&E, which eliminated its dividend in response to a big unknown for what their potential vulnerability might be for those big fires we had in the wine country last year. So, any number of things can take these stocks down, take the index down. This is SDP, which is ProShares. That's the symbol for ProShares UltraShort Utilities ETF. And it's based on an index, a Dow Jones index that's not the Dow Jones Utilities. It actually is one that roughly mirrors the Dow Jones Utility average, but as I've compared it, is actually mirroring more the index that's behind the iShares XLU and the S&P utility subsector index. So it's a proprietary index that's behind this ETF, but it's more definitely more weighted towards those larger, more inclusive indexes in the Dow Jones Utility Average. Well, as you can see, this bet and this graph goes back about a year. You can see the early part of this bet. Utilities were by fits and starts, but really continuing to rally. Then we got to, of course, the high point, and that was actually a point where we doubled our position. And as a result, this is where we are now in this trade. Now, we're not at the high point for SDP, and that means, of course, that the utility average has not revisited the lows from mid-February. We believe we are kind of getting close to a moment of truth here, where you're seeing this the SDP. Again, it's kind of the inverse of what you'd see for the utility average, and it's an ultra ETF, meaning that it's designed to leverage your gains. In this case, 2% gain for every 1 point drop in that utility index. So, but it is getting down to the point where you're getting pretty close to or you're kind of dancing right along that 50-day moving average. At the same time, the 100-day and 200-day is moving up. So we're kind of at a test point. We do protect our positions by stops. So we have a stop in here on this trade, and should utilities really reverse things and rally hard, and you can't rule that out in a trading environment. We will be out, and we'll be looking to re-enter again. If this does follow the example of 1987, we will see many fits and starts, many ups and downs in this utility average, and it'll rally with the broad stock market. Very likely, if in 1987 it was it didn't rally as hard as certainly as some of the other groups, but you did have your upturns in amongst the downturns, and we'll be looking for another upturn in that index to bet on this SDP. But again, this is our longer bet, our bigger bet that we've layered into, and this is something that we do in PVB. We did it with oil. We had that was, of course, one of our original trades in the service. While that lasted, we actually came around on the other side of that, and we're long for a while. We were short again on that, and these were again, we built into these positions, and that's what we're doing, and that's what we've done here with SDP. Again, with the understanding that if we do hit that stop point, we'll be out. So let's take a look at the next slide. And I'm going to turn this back over to Elliot. And this concerns, again, the kind of buy the dip trade that can be very successful in this type of environment.
Yeah, thanks, Roger. The next part here, I mentioned that I would discuss my favorite sector to buy on this dip in the market. And I just want to start by talking about a simple little screen that I do whenever we get a correction in the stock market. And honestly, I kind of missed this screen last year in 2017 because we didn't get any pullbacks to really buy. We got a couple of little shakeouts maybe in June of last summer, for example, August in certain sectors, but we didn't get that 5% or greater pullback that we typically see 3 of every year. But one of the things that I like to look for when the markets sees a correction, and specifically I'm talking about a correction such as I believe we've been seeing right now since January 26th, not the end of the bull market, not the actual top, but a correction, as I said, what I think we're in right now. I like to look for stocks that have outperformed in the 6 months leading up to the market top, the 12 months leading up to the market top, and during the correction. In this case, since January 26th. So what I did is I screened the S&P 500 for stocks that rank in the top 1/3 of the index in terms of performance over 6 months, 12 months, and since January 26th. And what you see here is it came up with a total of 80 some stocks that fit the screen. And what I'm showing you here is what sectors those stocks were in. As you know, the S&P has 11 official economic sector indices. And here's what came up. As you can see, IT, which is information technology, had the most number of stocks that screened well on this basis. Industrials and financials are the other 2 prominent players in terms of there are a lot of names that came up on the screen. Why does this screen work? Why has it worked for me in the past? The reason is that if you think about it, when the market pulls back, let's say the S&P pulls back 10% like it did earlier this month, that means that by definition, most stocks are going to be going down, right? So over time, most stocks follow the market, especially when the market falls. There's certainly some exceptions, but for example, in 2008, there were only a handful, like a dozen stocks in the S&P that actually closed 2008 higher. So most stocks are going to follow the market. The stocks that don't follow the market are going to tend to fit in basically one of 2 categories. Either they're extremely defensive stocks that people tend to buy when the market dips, like maybe gold, right? Or in 2008, I believe Walmart was actually higher on the year because it's kind of a defensive retailer, not as leveraged to consumer spending as a lot of retailers out there. And the second category are stocks that outperform during the correction, are stocks that are seeing that institutions, the big mutual funds, exchange traded funds, actively traded hedge funds, for example, that dominate the market trading action. Quantitative funds, for example, these days are another important big player, elephant of the market, if you will. A stock that outperforms during the correction is the stock that's being accumulated by those big money players. So in other words, the big mutual funds are buying the dip. The big quantitative funds are buying the dip in that stock. So this screen kind of has 2 parts. Stocks that performed in the 6 to 12 months leading up to the market top are stocks that they're not just defensive companies that are going up because the market's down, They're stocks that are showing a lot of momentum, a lot of strength behind them, even in the good times. And then that they outperform during the correction tells us that they're under accumulation on dips. So the big institutions are buying them on dips. Historically, the stocks that screen well on that basis outperform the market during the recovery from that correction. So as I said, tech, industrials, and financials, all three of those sectors screen well on that basis. And those are three sectors that we've been watching to trade. Our first trade, if you will, on that sector is in the financials, which we're particularly bullish on. A lot of financials, banks in particular, regional banks, and also larger super regional banks like Comerica and SunTrust, they tend to benefit from rising short-term interest rates. And the reason has to do with the fact that a lot of their loans, especially their commercial and industrial loans, reprice higher, carry higher interest rates when short-term interest rates rise. So banks are one of the only sectors that can actually benefit directly from rising interest rates. So banks tend to do well in periods like this where interest rates are generally on the rise and the Fed is hiking. So that's one reason we like financials from a fundamental perspective. And from the screen perspective that I showed you here, they're one of the sectors that held up the best during the market pullback. Just to throw a couple of tickers out there, if you look at a name like a Zion Bank Corporation or a Comerica, you'll see that, symbol for Comerica being CMA, you'll see that those stocks over the last few days actually made new 52-week highs, even though the market remains below its 52-week high. So that relative strength is a good sign. We're trading it using call options on the financial spider, which is an exchange traded fund that tracks a lot of tracks all the financial companies in the S&P 500. The symbol for the spider itself is XLF. And you can see here, now this is as of yesterday's close, so it's down a little bit more today, but you can see that that has rebounded almost to it, on this most recent rally, it rebounded almost to its January 26 high. It is still holding above its 100-day moving average, which is that green line. It's well above its 100-day moving average. It's well above its 200-day moving average, which is that yellow line on your chart. In contrast, the stock market went down and tested its 200-day moving average and is currently trading below its 100-day moving average. So XLF showing good relative strength. We're trading it using the June 30 call options on XLF right now in pig versus bear. And I'm going to show you in a little while how we trade those options. We use a strategy called rolling up, and I'm going to explain that a little bit later on in today's webinar. But the key takeaway from this is if you want to know what to buy on a pullback, look for stocks that are holding up well during that pullback. Because what that tells you is when they're selling, when there's a correction, when there's a dip, those are the stocks that the big boys, the big institutions, big boys and big girls of the world, right? The big institutions, the hedge funds, the quantitative funds, the mutual funds, et cetera, are buying on the dip. Those are also the stocks that are likely to outperform on the next leg higher. So with that, I'm going to turn it back over to Roger for our next little segment of today's session.
Thanks, Elliot. And, you know, we mentioned income stocks again, and this is sort of the another way of playing these things. That's why I put this slide up. This is actually called an options monitor graph, courtesy of Bloomberg. And what it tells you is, those of you who are familiar with options, there's a lot of information on this slide here. Basically, what you have are on the left you have call options, and on the right you have put options, and they're grouped by month of when they expire. So that would be the 16th for the March options there, which are at the top of the top listings there. That would be the 20th for the April options, the 20th for the July options, the 19th for October. Those I won't get into a detailed explanation of what options are, but basically, you know, when we basically put options, give somebody the right to sell a stock at a certain price. So there you're betting on it for it to go down. And a call option, if you buy a call option, that gives you the right to to buy a stock at a certain price. So if that stock price goes up, those call options are worth more. We do things a little bit differently here than that. And the opportunity here, and particularly in some of these income groups that historically have very, very low volatility, is what's called implied volatility. And this is something inferred by what people are paying for options. So if somebody thinks, for example, that, or if enough people believe rather, that the stock here, which is Edison International, is going to go down between now and say April 20th. So they'll be looking at these April options. They'll be buying put options, and they'll be, by buying them, they'll be creating demand for those put options, and they'll basically be pushing up the prices for those put options. Conversely, if people believe Edison's going to go up, but between now and April and the 20th of April, they'll want to buy call options. So they'll be pushing up the prices of these call options. And what that translates into is a price for these options that is significantly above the strike prices on these options. So people are paying, so for example, if people are paying, if Edison here is trading at $60 and people are paying $1.85 to buy these options, they're essentially, and the price of Edison is $60.91. You're essentially buying these put options. You're essentially giving away $1 of share price there. That Edison has got to fall at least that $1 for that put option to be worth something. So that's kind of what we're after here. In making these trades, we want to take advantage of when people are really getting excited about one of these stocks rising or falling, and they're paying a lot for these options. So then we don't want to buy these options, but we want to sell them. So in the case of selling a call option, your risk is that the price of the stock goes up enough, and you have to cover that option at that share purchase at a fairly significant premium. In the case of when you sell a put option, the worst thing that happens is the stock is put to you. So you have to buy shares of Edison stock, for example. So what we do, and the strategy here, and we do have a trade out there making that betting on that in this sector, is we're selling a put option that trades at a fairly high price, and that has, in other words, high implied volatility, and betting that the next time that we do get a nice up move in this sort of choppy market that we've entered, then the value of that put goes down, and we can buy it back at a low price. Now, when we make these types of trades, I know that sounds fairly complex. When we make these types of trades, we do tell you exactly what it is you need to do to make the trade. But it's actually a quite easy way of making some money off of when you do have a volatility spike. So in this case, we have a company, Edison International. It's a big California-based utility. It's volatile because of what's going on in the utility sector, some of the worries about interest rates and so forth. But it's also volatile because of concerns about what's going on in California, particularly regarding various wildfires we have out there. So you have a lot of people betting on the thing to go up. If you take a look at that IVM column here on this slide, that's about, there's IVM for on both the put side, which is on the right side of the page, and also the call side, which is on the left side. But IVM, the higher those numbers are, that means the higher implied volatility. So this stock typically has much lower implied volatility over time, and again, and so what that tells you, volatility is elevated in these things, and we do have an opportunity to build a position in there. So we'll typically recommend selling a certain number of puts in the trade. We'll also try to recommend, again, because as Elliot pointed out, half of you are interested in buying and shorting stocks or ETFs and so on. Like I mentioned, that SDP trade. And roughly half of you are interested in trading options. So we'll also have a non-options alternative to the trade. But this is, and these positions tend to be somewhat smaller than the bigger trade that I discussed, the SDP, the short utility trade. We do run this thing not as a bunch of individual trades. We run it as a portfolio of trades. So some of the trades at any given time are going to be a lot larger than some of the others. That's also a way we can control risk. Obviously, when you're buying and selling options, you are taking more risk to your capital because than you are with simply buying or selling an ETF or a stock. And that's simply because options expire at one point or another. So if you're out of the money, or if, in other words, your option doesn't have any value, then it becomes worthless. Conversely, a lot of leverage, say if you're buying or selling an option, because all it takes is a small movement in the stock. For example, taking a call, for a call option, trading at $1, a 1 point move up in that particular stock doubles the value of that, can double the value of that potentially that call option. Very simple example, but and of course there are nuances that we do explain, but bottom line, a lot more leverage in that, and therefore those types of positions would tend to be smaller than the other ones, but but also very enhancing to the value, and a lot of opportunity out there, particularly in this market. So unlikely stocks perhaps to be trading and trading around with. Utility stocks, mostly people think of those as long-term, but we do, I think, have a big opportunity in the ETFs and stock side to play these things, but also with options. So definitely a big theme with PVB. Utilities are one example, but also you have other dividend-paying stocks that we have opportunities to do that in. I think Elliot's going to discuss our one of the other an options trade in one of the other groups that I mentioned early on, the MLPs. But I'll turn it back over to you for the next slide. Oh, actually, this will be my point. So, this will shift gears a little bit. This is actually a short position, and I mentioned an area of the market that in your introductory letter to this webinar, an area that I'm very interested in short selling. This is a pretty good example of that. This is First Solar. It's a solar company, manufactures solar panels, and that's a very, very competitive market. It's definitely a global market at this point. The U.S. Is certainly major consumer of solar panels, a major adopter of solar, but it's by no means the only country doing so. In fact, China is now the largest market, and also because of that is the largest manufacturer. Now, the U.S. government has imposed tariffs on imported solar panels, and that's helped First Solar. They do have a very international supply chain, but they manufacture their panels from thin film solar rather than crystalline silicate. And the crystalline silicate was named in the suit that was brought by a couple of manufacturers in the U.S. that alleged harm from importers of solar panels. We're successful at the U.S. International Trade Commission in getting a recommendation that was again later on taken up by the president to impose those 30% that 30% tariff. The industry pretty much was expecting that. It was talked about for a long time. It was actually a lower tariff than many people had thought. So you haven't had a whole lot of disruption, and that's also played to First Solar's advantage. So you can see what's happened here with the stock since February of 2017, roughly the last year in this stock. Steady movement upward. That's primarily the result of this tariff, which has favored it over other solar manufacturers. So that's what's in the price so far. Now, why would you go in and look to short this particular stock? Well, we have in the past, we have actually shorted it in PVB a couple of times. The first time quite successfully. Second time, not so much, but we did have a stop in place that protected our loss. And since then, we've basically been looking for another opportunity to get in. We haven't really seen it. The stock has continued to hold above its moving averages, but our view is that we will see a breakdown for a couple of reasons. One, tariffs or no tariffs, this is still an extremely competitive industry, and First Solar has made some considerable advances, automating its product line and so forth, but it's by no means the most scaled up or successful company in the space. So even though it does enjoy the protection of tariff walls to some extent, that's only limited protection. Those tariffs actually start unwinding next year. So it's a limited, very much a short-term advantage. Second of all, you're still looking at a company that, at least from a product perspective, is shedding revenue. So it's doing much less well than it was a few years ago. That point is somewhat masked by the fact that when they sell assets, that has counted on their income statement as revenue. I don't know of any other business where that is the case. But in the case of First Solar, they do have the ability to put those from what really amount to asset sales into revenues. One of the biggest ones that they have been looking for, and another reason we didn't go back in as a short sale over this past year, is the sale of their stake in what's called a YieldCo 8.3 energy partners that they own conjointly with SunPower. They reached a deal that was actually well below market price for selling this YieldCo. That it's contingent on the minority shareholders going ahead. My view is that they needed the cash, and they were more interested in an all-cash deal than something that involved stock in something else. And again, we're not privy to what those other offers that allegedly were out there, what they included, but that does appear to be the case from just looking at the recent moves and earnings from First Solar, and particularly SunPower, the other partner in this in 8.3, the other sponsoring parent. Just a lot of signs that they did need cash, and it's no surprise that remains at a premium for these companies. Again, they're competing against companies that are actually many times their size, that have very secure home markets, and are driving costs down. One reason that solar has been so heavily adopted, and probably the biggest reason solar has been so heavily adopted globally and also in the U.S., is just the fact that the price of solar panels has gone down astronomically as efficiency levels have gone up. Well, that's been driven by this massive scaling up that you see in China in particular. But those are companies that compete with First Solar in this business, and I think First Solar, basically where it's trading right now, priced as a technology stock. Certainly, a lot of people consider solar power to be a technology business, but they're basically just a manufacturer. They're successful to the extent they can build a better mousetrap than and cheaper, more cheaply than the next guy. So while you've gotten this big benefit from the tariffs, and it's showing up here in the share price, The bottom line is it's still the same business, and now it's an even higher priced company that is competing with bigger and stronger companies. And the history of manufacturing and the manufacturing business, no matter what you're talking about, is the larger players. When you do get to a type of business where you're producing a commodity, and solar panels are definitely a commodity, you if you can't be the biggest and the best, you do tend to continue to lose ground. So it's a manufacturer, it's priced as a technology stock, and even though solar energy continues to be adopted globally, even though they do have this tariff walls protecting them at least temporarily, and it will protect the launch of a particular solar generation of panels that they're producing. They call it generation 6. These are all temporary. They're all baked into the share price, and we're looking for a break below those longer term lines as an opportunity to come in with a short. Now, when we do a short sale, we will protect it with stops. And like I say, that's protected us when things have moved against us, when there's something has happened that we haven't seen. Certainly those tariffs were an area that I think would have been probably laughed out of court in previous administrations. But right now you have a administration that hasn't been pretty free about employing various protectionist measures, slapping on tariffs. There was a steel tariff just recently announced, which actually will hurt companies that are building solar facilities like First Solar, ironically. So we believe, again, commanding a valuation that will fall apart, and we're looking for a technical signal to put on a trade. So that's my favorite short candidate at this point. Again, very carefully and very cautiously to make a trade. We're not just going to slap something down there, and we're going to make sure that things are on our side. But it's definitely set up for we believe a good opportunity. And I guess now I think Elliot, you're going to talk about the another income stock group that we think has a lot of upside.
Absolutely, Roger. Thanks. I'm going to talk now about the Alerian MLP exchange traded fund. The symbol for the underlying ETF is AMJ. And many of you may be familiar with the Alerian MLPs and the MLPs in general, which stands for Master Limited Partnerships. They're a group of high yield securities that are tax advantaged as well, that tend to own midstream energy assets like pipelines. Roger and I have been covering these as part of one of our longer term services for years, as part of various longer term services for many years. I know I started looking at them way back in 2002, and I think Roger has probably been looking at them for a lot longer than that. But today I want to talk about not buying MLPs for a long-term investment, but actually trading this group, which actually, even though it's a high yield group, it's tend to be thought of as a pretty conservative long-term income investment, and that's certainly how we pursue it in other services that we have, like Energy and Income Advisor. It also actually provides an awful lot of trading opportunities. And specifically, I want to talk to you today about an options trading strategy we called rolling up, which we've used in the Alerian MLP ETF since mid-December. So just here over the last few months now, 2.5, 3 months now, we've traded this Alerian MLP ETF a few times using this rolling up option strategy. And I put this chart up. This is just the price chart of the Alerian MLP ETF. That first sort of goldish orange arrow you see, December 13th, pointing at the December 13th trading price for AMJ. That's when we first entered this trade. And all of these trades were in call options, whereas Roger explained to you earlier, are essentially you're betting on higher prices with call options. So we're trading call options on AMJ. It's been a trade that's showing right now a $1,620 profit based on a very small position of only $1,170. So well over 100% return since December 13th, betting on upside in the AMJ. Yet over this entire time period, it's actually down. So this strategy in this case allowed us to turn a stock, an ETF that actually has been down, into a very nice gain. And I want to show you exactly how we did that, how we turned this index, it's this ETF that's going down, into a gain using options. And again, it's a strategy called rolling up. Here's how we did it. And in Pig versus Bear, I should say as an aside, we assume about a $25,000 hypothetical model portfolio. That is just a guide for you as a member of the service. You know, we'll say based on about a $25,000 hypothetical portfolio, we'd recommend you buy or sell X number of shares of this stock, index, ETF, or option. So we're basing it off a $25,000 hypothetical portfolio. You know, I talk to a lot of readers who trade more like $100,000, and in that case, you would multiply our recommended position sizing by 4. We include those position sizing because obviously some things are riskier than others, and we don't want to bet the farm on something that is very volatile stock or very volatile option. We're likely to take a smaller position as a means of controlling risk. So in this case, based on that $25,000 portfolio, we recommended a 10 option contract position in the March 16th, 2018, $27 call options. We recommended them at a price of $1.17 each, which works out to $1,170 for all 10 contracts. And again, that was back on December 13th of last year, so less than 3 months ago. Then on January the 1st of, I'm sorry, it's actually January the 2nd, the first trading day of this year, we bought 10 of the $28 call options for $1.05 each. So that was $1,050 for those 10 contracts. The reason being is over that time period, as you can see on this prior slide, from that first orange arrow to that second orange arrow, the Alerian MLP ETF started to rise in value. And as you can see here, and I won't go into the specifics of all the technical indicators we look at, but just simply put, we saw the Alerian MLP index kind of range bound here through the end of December. And then early in the new year, on the first trading day of January, it broke out and we added to our position in the Alerian MLP ETF. So that was a simple matter of that's why we did that. And if I move back to this other slide here, so we had a total of 10 contracts of the 27 calls and 10 of the 28 calls. Then on the 12th of January of this year, we sold those $27 call options for $2.85 each. So remember, we bought them at $117 and we sold them for $2.85. So that would be a sale price of $2,850 for all 10 contracts. And the total profit on that trade was $1,680. So we closed that position outright. We still own the 28 calls, but we closed the 27s. Then on that very same day, we rolled into the $30 call options. Now, why do we do that? And this is where we call rolling up. In other words, we're rolling up to a higher strike price. The $27 call op, because the price of the Alerian MLP index by that time, and that would be this third orange arrow you see here, had risen all the way from the original entry points a little over 27 to more like 29.50. So at that point, those $27 call options are well in the money. They're become much more expensive. So we have a nice open profit in those. We closed and took that profit and bought the 30 calls instead. Now the 30 calls, because it's a higher strike price, are worth less. And in this case, we were able to buy them for 75 cents each. That's just 750 for 10 contracts. So look at what we're doing here. By rolling into a higher strike price on this contract, we're taking a profit on the original trade, again, of $1,680. And we're only putting a little bit of that money back to work in the market. We're only putting $750 of that back in the market in those 30 calls. So we've lowered our risk in this trade from $28.50 when we sold it just to $750 for those March contracts. Then a few days later, on the 23rd of January, which is the fourth orange arrow you see, right near the high for the Alerian, as you can see there, we sold those $28 call options for $260. We purchased them for $105, so it was well over 100% profit, and that yielded a total profit of $15.50. Now, at this point, we've taken two profits. We've turned paper profits into actual profits of $16.80 and $15.50. But we still own 10 of those 10 Alerian $31 call options and 10 Alerian $30 call options. And the reason is those are both bets on even higher prices for AMJ. Well, at that point, right, the whole trade started to fall apart. The market fell apart on the 26th, and the Alerian index has made a quick trip back down to under $26 as of the time this chart was created last night at the close. So the Alerian, unexpected to us, sold off. So we're underwater on those last two trade entry points. But because we were able to use the rolling up strategy to take incremental profits on the rally, we have incremental profits on this trade that are worth more than our current exposure to the Alerian call options. So now we still have some upside exposure if, as we expect, the Alerian recovers over the next couple of months, because we have some June call options in the Alerian. But worst comes to worst, if we're totally wrong and the Alerian falls apart, we still get to keep that entire $1,620 profit on the trade. And I go through the exact math here on this last bullet point. We took total profit on those closed contracts of $32.30. We still have a loss on the last two open contracts we have out there, are $16.10. That's a total profit of $1,620 versus our initial risk in this trade of only $1,170. So even though this trade, the AMJ pulled back way more than we ever expected at the end of January, we thought it might continue rallying up to the $32, $33 area. It didn't. It took off and went the other way. So we were wrong about further upside in this. Because of the way we managed this trade, taking incremental profits and rolling to a higher strike price option, then when we get a little bit more upside, we roll to the next higher strike option. And then when we get a little more upside, we roll up to a little bit higher strike price option. This rolling up strategy allowed us to hold on to our main gains, even though the market suddenly turned against us. And one reason we think that this is such a good strategy for the current market environment is because we're likely to see a lot more volatility like that over the next couple of years. It's typical in the latter stages of a bull market. And you want to, the first rule of trading is to ride a trend as long as you can. The so-called trend is your friend. And then the second part of that old saying is the trend is your friend until it's about to end, right? So what this rolling up allows you to do is maximize your gains as the trend, as a stock or index keeps moving up or down, and taking incremental profits all along the way. And then when it finally turns against you, you're not going to give back all your gains. You're essentially playing with the house's money because you've taken those incremental profits over time. So it's a great way of, I know when I first started trading decades ago, actually now, one of the things that was scariest to me was when I would buy a stock and it would go up, say 20%, right? And then, you have this little inkling sensation in the back of your mind, right? What if it suddenly turns down tomorrow and I give back all my gains, right? And, there are two choices you could make, right? You could hold on and then hope that it continues rising, or thinking that it's going to continue to rise to make more money on it. Or you could sell out and then risk that it continues rising and you miss out on the trend. But there's always that sensation that kind of keeps you up at night. Should I sell out and take the gain, take my money and run? Or do I really need to stay there and maximize this trend as much as I possibly can? And oftentimes the most painful decision is to hold on because you're constantly going to be worried about giving back those gains. In the options market, we have this rolling up strategy as a way of taking gains incrementally over time, but retaining your upside exposure to the stock or index. By the way, I know it sounds a little complicated when explained in this way. Hopefully that made sense to you with the chart. But we do actually, in our trade recommendations in pig versus bear, we're very clear saying, you know, buy this, sell this, buy this, sell this. And we give you particular price guidance, tell you exactly what to say to your broker, how to enter the trade with your broker in terms of what type of order, et cetera. So it's really quite simple. And it's a very powerful strategy that we've used successfully on AMJ, as I just showed you. And I got to tell you, we're also using the same strategy for trading that financials spider I mentioned a while ago, the XLF. So I'm going to open it up here in just a second to questions because you know, Raj and I, it's now 3:30, and I think that's actually pretty much on schedule for our prepared remarks. We'd like to open it up for questions at this point. If you have any questions, once again, I see we already have a number already filtering in. Just enter them on that Q&A box on your screen or chat box on your screen, and we'll answer all of them we can get to. Before we do that, though, I mentioned at the very beginning of the presentation that we have a special risk-free trial offer that we've decided to offer now because we believe this is such a great time to look at trading strategies and to give trading strategies a try. You may not think you're a trader. You may even have this sort of negative connotation in the back of your mind, you know, because of, you know, the day traders back in the late 90s or, you know, having to sit in front of your computer screen all day watching every tick in the market. That's not the kind of trading we do in pig versus bear. We're trading multi-week and in many cases, multi-month trends in stocks, ETFs, and using options. We think this is an excellent time for that type of strategy because traders feed on volatility, and we're likely to get a lot more of that as we enter the final stages of the bull market. In addition, some of the only people who can really make money in a bear market when the overall market's going down are traders, because you're able to profit just as easily from the downside in a stock or index or sector or bonds or commodities as you are on the upside. So we're offering this special. We very rarely open pig versus bear to new members. Last year we only did it once last year, so it's kind of rare that we open it up at all. But we are opening up the best offer we've given, frankly, from the beginning of the service through this Sunday, March 4th at midnight. We're opening up 20 trial memberships. We strictly cap the total number of subscribers in pig versus bear. We don't want to get in a situation where we recommend an option and we have so many readers that they pile in and move the price. We do strictly limit the number of members in the service, and we can only offer 25 memberships at this time. Normally, the cost of an annual membership is $19.99 a year. We are offering $500 off as part of this offer, making it $1,499 a year. You do need to use the offer code SPECIAL500. You can see it there on your screen. SPECIAL500 under annual membership. That will give you $500 off. And this is not just a one-time offer. If you sign up during this trial offer period through Sunday at midnight, and you type in that offer code SPECIAL500, you'll pay $1,499 for an annual trial subscription to pig versus bear. And should you choose to continue with your subscription next year, the year after, we'll never raise your price. It'll always be $14.99. We've been offering it $19.99 a year. We have not offered this $14.99 price in more than 2 years now. And I don't think we're unlikely to do it again. This is a special because we just think this is such a good time to give this type of strategy a try. So we do offer a forever guarantee. You'll never pay a dime more for your subscription, no matter what we're charging new members. Normally we have a 30-day risk-free trial. We are offering a 60-day risk-free money-back guarantee under this offer. Sign up today. Give us a try for 2 full months. We have weekly market commentary that comes out. We have trade alerts that come out. We have model portfolios on the website. We also, once a month, host a webinar, much like what you're listening to today, where we go through every trade we're recommending, some of the trades we see ahead, and we answer your questions. So sign up, try us out for 60 days, listen to our next couple of webinars, read our weekly emails, see all our alerts, just as if you were a paid and full subscriber. And if you don't like it, if it's not for you, we totally understand that pig versus bear is not for everyone. Maybe you don't like to trade. Maybe it's not the kind of strategy that interests you, or you don't want to do it for whatever reason. Cancel in the first 60 days, and we'll send you your money back, no questions asked and no hard feelings. Plus, for our annual membership, we're offering a guarantee that I can't think of I can't think of any way of making it an easier decision if you're interested. Basically, we have a model portfolio. As I mentioned in the service, it's about a $25,000 account should be enough to cover all the trades we recommend in there. If you follow our position size recommendations, 25 to 30,000. If our model portfolio allocations and recommendations don't earn enough based on our total portfolio, hypothetical portfolio, if the amount we earn over the next year in that portfolio isn't enough to more than cover your annual membership cost, we will extend your pig versus bear membership by 1 quarter, absolutely free of charge, until the profits in the service are more than enough to cover that annual membership rate. So basically, if it doesn't work for you and you stay on for a year, we'll keep extending your subscription until we make it good, quarter by quarter. We do also offer a quarterly membership option at $5.99 a quarter. Unfortunately, we cannot offer that money off the special 100 code on the quarterly subscription, but we can still offer you the 60-day risk-free trial. And we will guarantee that we offer the forever guarantee. In other words, we'll never charge you more than $5.99 a quarter, no matter what our price is to new readers. So that's the offer. It's only available through Sunday at midnight at 11:59 p.m. Eastern Standard Time, or until those 25 memberships are exhausted. Again, we do cap the membership to the service. So once we have 25 members under this offer, we're going to have to take this offer down and in fact close the service to new members. As I said, last year we only opened it up once, and I can't tell you when we're going to be able to open it up again. Now I'd like to open up the floor to questions. Again, if you have, and by the way, that website you see there is the website where we do cover some of the points about the current market cycle we discussed today. If you go to that website, you'll find a lot of the points we covered. That also gives you a link to sign up with that special 500 money back. Please use this website if you want to sign up to Pig versus Bear to make sure that we have that we've recorded that you were on this webinar, that you get the 60-day trial, you get the money back, and you get all those guarantees I mentioned. The only way to do that is either through that website or by giving us a call on that toll-free number on your screen, 1-877-302-0749. Our customer service manager will personally answer your call. Her name's Sherry. Just tell her that offer code I mentioned, special 500. Here, I put it on this slide here, special 500, just to make sure you get, if you're interested in taking us up on that trial, you get all those offers I just mentioned. So she is available from 9 a.m. in the morning to 5 p.m. Monday through Friday, Eastern time. So if you want to call in to take us up on the trial or find out more, you can call in over the next hour and 20 minutes or so, or anytime from 9 a.m. to 5 p.m. tomorrow. And again, this closes down on Sunday or once we fill up those 25 subscriptions. So with that, again, I'd like to open up the floor to questions. I know Roger's on the line as well. You can ask me, ask Roger, ask both of us. We already have, it looks like about 10 questions in the queue. Please feel free to type in your question at any time, and we'll answer all of them we can get to today. So why don't I go ahead, Roger, and I'll start reading off the questions. Okay. And again, please enter them in if you'd like. We'll answer anything you'd like us to. The first question is, when do you think the bear market will start? About when do you think the bear market will start? That's a very difficult question to answer exactly, of course. I can give you a couple of sort of guidance points to look at. And again, this is a very rough guess. Historically, and I looked at bull markets going back to the early 20th century, so over the last roughly 80 to 100 years. As best I can tell, the final stage of the bull market, that's the stage of the bull market I talked about where you get more volatility, you get more movement from sector to sector. We call it sector dispersion. In other words, some sectors are moving up, other sectors are moving down. The stock market's no longer moving as a herd. That final phase of the bull market typically lasts on the order of 12 months, plus or minus. So if you think that this volatility we've seen since the end of January marks the beginning of that final phase of the bull market, then that would put the bull market top sometime in early 2019. Again, a very rough guess, but kind of gives you an idea. The other thing I would look at is, on average in the 20th century, the US stock market has peaked about 7 months prior to the US entering a recession. The indicators I look at tell me that it's very unlikely we'll see a US recession within the next 12 months because the economy is still accelerating. So I think that a good bet for the first available time that I would think a recession would be not possible, but more likely would be sort of the second half of next year, 2019 or early 2020. Count back about 7 months. That would also point towards the first half roughly of 2019. So to answer your question, I think the first half of 2019 is my sort of loosely, that's sort of what I'm looking for. Of course, it's not set in stone, definitely not set in stone. And we're going to let the indicators and the market itself tell us when the bull market is ending and has ended. And we will trade accordingly in pig versus bear. But that's a rough guess that I have of that. I don't know, Roger, do you have anything to add? Or?
Well, I mean, all I would add to that is that in pig versus bear, we've talked a lot about today stops that we use. And so regardless of which side of the market a particular trade is on, we will be very technically plugged in. So in other words, if a bear market begins and we have a bunch of longs in there, we'll be taken out of those positions, rather quickly. The other thing is just that, often these bear markets are defined, or pretty much always, a bear market's beginning is defined kind of retroactively or with 2020 hindsight. So again, if you are, waiting for some sort of, magic, bell to ring at the top of the bull market, you're likely to be waiting for a while. I mean, these things tend to bull markets tend to, or bear markets tend to begin not with a bang, but with a, no one ringing the bell, but with a whimper. And even if you go back to that graph I had of 1987, or any graph of 1987, you can see that the actual top was several months before the Black Monday crash. So it's the way to play it, I think, and particularly at the end here, is to is with this kind of trading approach. And I mentioned some things that I've been doing and we're doing in many of the longer term services to be prepared for when that does happen. But when the big turn begins. But in pig versus bear, this time is kind of ideal because not only are you betting in a leveraged way on this volatility, but the chances are you're going to be very well prepared for when things actually do start heading down in earnest. And the history later on goes on to mark the end of the final end of the bull market that has been pronounced dead several times before. But really, this is started back in, I guess, March of 2009. So, yeah, I think trading's a good approach.
Those are good points. So the next question here is from an anonymous attendee. We seem to be in a new place with Trump in office. Policies and statements vary day to day with regards to trade, foreign policy, possible conflicts, etc. we are unlikely to see any further changes in the tax environment. Can you please comment on the possibility that a market fall could be caused by a catastrophic event and not a long-term economic trend? Sure. I would say one first thing is 2 points. One is that it depends upon what you mean by catastrophe. If there's a nuclear warfare tomorrow, if North Korea were to lob a missile at Japan or even the United States, obviously that kind of an event would cause a rapid sort of air pocket in global markets. You'd probably see a big sell-off. But I would point out that leaving the short-term politics aside, global markets have been through a series of major, and even in some cases, what I would consider to be anyway, catastrophic events over time. And this, just off the top of my head, we've had 9/11, we've had the Lehman Brothers bankruptcy in 2008, the 1987 crash that Roger mentioned, the portfolio insurance many people think causing that crash. We had the Cuban Missile Crisis, President Kennedy being shot, the OPEC oil embargo back in 1973. We've had World War I, we've had Nazis in World War II, Vietnam, Iraq, Korea, the long-term capital management hedge fund blow up back in the late 90s. The Asian economic crisis in 98. We've had hyperinflation in some countries over the last 100 years, including in Venezuela today. And in the US, we had very high inflation in the 70s, of course. President Reagan was shot in the 80s. President Nixon resigned. We've had Brexit just a couple of years ago. We've had the recent sort of war of words, if you will, with North Korea. We had some surprise things as well, right? Such as the presidential election a couple of years ago. So, that's kind of just off the top of my head. Undoubtedly, Roger, you can think of plenty of other examples, and I'm sure a lot of our listeners can too, but those are just kind of some things off the top of my head. And what I can tell you with a lot of these crisis or catastrophic events is I can tell you two things. One is that they typically accentuate the trend already in place in the market. For example, when 9/11 happened, it was a horrible morning. Many of us remember watching that happen live and watching the market reaction live, market being closed for several days. But the fact is the US stock market was already in a nasty bear market on the day before 9/11, and 9/11 saw a big sell-off, but it was right in the middle of a major bear market in the US. So it kind of accentuated the trend already in place, but it didn't cause the bear market back in the early 2000s. Same thing in 1987. I think as Roger alluded to several times, a lot of people seem to think that the 1987, October 1987 crash, which was unprecedented at the time and since, right, kind of came out of thin air. But the truth is that the stock market actually topped out in August. We saw several major corrections before then over the course of 1987 and late 1986. And market breadth was actually deteriorating well before the stock market topped out. So there were, the 87 crash really ended a bear market that had already begun earlier that same year. And then on the other side of the coin, for example, a lot of people last summer were asking me, well, if North Korea and the United States keep, sort of up-leveling this rhetoric, won't that bring an end to the bull market? But what really happened was, because the market was rallying for economic reasons, traders just used any North Korea news as an opportunity to buy the dip in the stock market. So oftentimes these types of major events or crisis type events will accentuate the trend already in place. In addition, I do think that typically the tape itself tells a tale, is kind of the old saying. The technicals in the stock market, the kind of things that we talked about today from a trading perspective, will tell you when something bad is happening in the global economy or in the global geopolitical situation that could be trouble ahead for the stock market. Typically, it just doesn't come out of thin air. For example, the stock market started to tell us that inflation and oil prices and commodity prices were a problem long before the stock market topped out in 1973. And as I said, we saw it in 87. So I do think that there's a very famous book, actually, many of you may have read it. It's called Reminiscences of a Stock Operator. And I think it was published in the early 1920s by this guy named Edwin Lefebvre. And it's about this Jesse Livermore was his real name, who lived back that time. And he would talk about how the stock market often predicted calamities, such as there were a series of market panics back in the early 1900s. There was also, the market started sort of anticipate World War I before World War I actually kicked off. So it's uncanny sometimes how the stock market can not only lead the economy, but can also lead catastrophic events. So I would say, yeah, I mean, you can never price out totally the possibility that something truly catastrophic, like, as I said, a nuclear war between North Korea and Japan, or North Korea and South Korea, could happen and could, sink the market 15 or 20% in one day. But history shows that those kind of events are relatively unlikely. And typically when geopolitical tensions are escalating to the point that you could have a catastrophe, or economic pressures are building to the point you could have a catastrophe, there are warning signs ahead of time. So I don't know, Roger, I don't know if you have anything to add to that, but that's my take.
Not really. I mean, big declines, the only thing I would say is big declines are often bullish events. They kind of get rid of the excesses maybe that have run things up. So by the time you do get a big decline, and that tends to be the kind of sell-off that occurs after, if there is like a significant event. They used to call it, the black swans. That was a buzzword earlier in the decade, a successful book as well. But bottom line is that if we did see an event like that, it would probably be it would probably be a bullish event. Coming out of there, at least or a time to, think about buying rather than, the beginning of a prolonged slump. But of course, like, as you said, things are often, market history doesn't repeat. It often rhymes, but we are going to take our cue, and particularly in the trading services, and protect ourselves from big reversals by, employing, smart trading ideas and tactics.
Yeah, that's a good point. I mean, both the 87 crash and actually 9/11, if you'd bought the market on the day after the 87 crash or the day after the market reopened after 9/11, you might not have made money that day or the next day, but within a couple of months, that would have been a pretty awesome trade in both cases.
Yeah, it's a great trading opportunity. I mean, the market itself, kind of bounced around after both of those events. But, that was, again, that points out also the fact that often your best opportunities on the long side or on the short side occur in the context of a market that is, short side or when the market's going up, or alongside when the market is going down. It's just simply looking for your opportunities on different days and in different securities.
Yeah, absolutely. Okay, I'll move on to the next question. This reader asks, I thought that the Ultra and Double Ultra ETFs, exchange traded funds, both the Bull ETFs and the Bear ETFs, are good short term. He says over a day to a week as a trading vehicle, but then on a longer term basis over months, they drift away from the underlying symbol. We get this question a lot. In fact, last year and really late 2015, early 2016, when we were doing a lot of trades in leverage ETFs on oil and also the stock market, we got this question even more. There are a couple of things at work there. Sometimes this comes out as sort of a rule of thumb. You'll hear this kind of pronounced as a rule of thumb that you don't want to own ultra or ultra short ETFs over more than just a few days or a week. The reality is, the long and short of it is that that's not really true. we have traded ultra and ultra short ETFs over periods of many months and done extremely well with them. But I'll tell you where that comes from. Let's take the SSO I mentioned a while back for the S&P, right? So that's a double leveraged S&P ETF. It's designed to go up in value by 2% for every 1% that the S&P 500 goes up. So if the S&P 500 goes up 1% on a given day, it should go up by 2%. The ETF is very good at tracking that on a daily basis because that's what it's trying to track, the daily price change in the S&P over 1 day's trading. However, just mathematically speaking, if I tell you that the S&P goes up 2% on Monday, down 1% on Tuesday, up 3% on Wednesday, and so forth, even though the ETF is matching double the daily price change in the market, over the course of a week or 2 weeks or 3 weeks, that's going to diverge from the long-term trend. So in other words, if the market goes up 1% tomorrow, SSO is going to go up 2%. But if it goes up 5% over the next month, it doesn't necessarily mean SSO is going to go up 10%. It might be more, it might be less, depending upon the pattern of those percentage daily changes. In commodity markets like oil, you also have the roll effect, which is that most of those ETFs are using the futures to track the price of oil. So they might be trading April futures now, but in a couple of weeks they'll roll into the May. So it depends upon, and I'm not going to get into all that on the call in the interest of time, but depending upon how they roll, the ETF could outperform or underperform the market depending upon the shape of the futures curve. So that's the technical aspect there. What we found in trading these things in pig versus bear is that while they might not track the underlying index exactly, if the stock market goes up to a new high, as we think it will over the next month or two, SSO will still show strong percentage gains. It'll still move higher, and it's likely to move higher much faster in percentage terms than the overall market. We think that the tracking error that you're talking about really doesn't come into play until you start holding ETFs for 6, 12 months or longer than that. And that's where the divergence can get so large, it can, irreparably impair the trade, if you will. So, it's an issue. It's a technical issue. It's not an issue that, it's not as big an issue as some have proclaimed. And, frankly, we've had some very good trades on these leveraged ETFs and leveraged bear ETFs that have lasted much longer than a week or two. We've had some lasting even 6 months and have been very successful for us. It's, you shouldn't have a hard and fast rule not to trade them for longer than a few days or a week. You have to look at it on a case-by-case basis. And that's one of our most successful and profitable areas of trading in pig versus bear.
Yeah, and it's a little bit, taking that approach of not holding these things or not buying them. It's a little bit like not taking a profit in a stock because you're afraid of paying a commission, not even the tax thing. I mean, it's a cost of the trade of using these things, but it actually is not as great of a cost in many cases as owning the leverage would be in something else. So again, you kind of weigh these things off. I mean, I think one thing we like about them is they're simple. You just buy them as though you would an ordinary common stock. You don't need even need a margin account or anything of that nature. They're marketable, equitable. They're marketable securities that tend to trade in fairly high volume. So, we think that, and this is how we've answered this question many times. I mean, we do know we think and we have seen, again, demonstrated again and again that if you get the trend right, you make money in these things in a much bigger way than in a non-leveraged method of trading.
Yeah, absolutely. And we have actually we have a number of questions from the same listener here that are probably a little more on some of our longer term services, sort of the nature of the question. But I'll go ahead and read them just so, maybe we could make a few comments here. First question is, are there any high dividends, income, or exchange traded funds you would recommend for a Roth IRA retirement portfolio for income? Are there any closed-end funds for income, retirement income? And then this kind of the same question about yieldcos as a safe area for retirement income.
Well, I mean,
we'll start with those.
Yeah, well, like first with the ETFs, I think they're generally a bad idea for as a substitute for individual stocks. And if you've ever subscribed to any of our longer term services, I mean, basic reasons are you own the good and the bad and the ugly, and you own an index. And at any given time, some of those stocks within that same sector are good, and some are not. There was just our Conrad's Utility Investor universe. It's about 200 companies. They're all essential services providers. Last year, the difference between the performance and the best performing stock in that 200 stock group, again, we're talking about utilities, telecoms, very, very steady things that stay around for a long period of time. The difference between the top performer and the worst performer was over 200 percentage points. So, I mean, that's you add that together, you got something up 100%, something down 100%. If there was an ETF of those two stocks alone, that's a 0% return. So, again, that's you do much better picking individual stocks than an ETF. Regards closed-end funds, I think these can be more interesting. You have to realize that you're not buying individual securities; you're buying a portfolio manager and their ability to pick well. And that's often a good bet. I do have some picks in Conrad's Utility Investor. I cover about 5 different closed-end funds. One, a BlackRock offering. Actually, to give you a name, BUI, Barry, Ulysses, Irene, the symbol, and they own a global portfolio of utilities and related kinds of stocks. One of the stocks they own is actually a toll roads owner that I like, that's based in Australia and has operations throughout the United States. So that's interesting. Again, it's just a unique kind of situation, and I'm betting on the management because take a look at their portfolio at any given time. That's a snapshot, and it's not going to be current, with whatever that is in there. So you're taking it on faith, basically, but there are some examples of some pretty good closed-end funds out there. And finally, the yieldcos, we've written quite a bit about them. That's kind of out of the purview of PVB, but I wouldn't rule out making a trade on some of them at some point. I think this group's very exciting. For one thing, it's quite out of favor, but we have had I would call it an ownership or sponsor turnover of sponsors for a number of these entities that has left them in the hands of much stronger owners. I mean, the real wrap on the yieldcos, and you can read my what I've written in the various publications. Actually, Deep Dive Investing, I've done some pretty extensive work on these things there. But bottom line is that the sponsoring entity, the company that's supporting them, the company that's dropping assets down to them through favorable sales, has to be very supportive, and now more than ever, because the group's out of favor and it's harder for them to raise outside capital. So I view that as extremely positive. I think there's of course obviously some big yields. There's obviously some great distribution growth rates out there and at very low valuations, but those are, I think, quite interesting. I wouldn't ever load up my portfolio with any one sector or any one particular stock, but there's certainly some interesting choices in that sector.
Yeah. Okay. And I guess we have the one more question we have from the same listener is, do we recommend selling put options or using call options in a Roth IRA for needed retirement income? I would just say that we do recommend, I think Roger referenced selling puts on stocks as a way of earning income.
Mm-hmm.
And, you know, in some of our longer term services, in particular, one of our newest services, Deep Dive Investing, lately we've been doing recommending some covered calls or selling puts as a way of, you know, earning additional income from long-term recommendations that we like. And so I do think that can be an interesting strategy. I honestly don't know about trading that type of option in an IRA. Roger, I don't know if that's...
Yeah, that would be my question, is if your account is able to handle it. I know this is a strategy that a lot of brokers will try to discourage you from doing, and they may actually have rules in place that you know, don't allow them to do that. There's obviously been a pretty intensive re-look at the financial services industry since, well, you know, since over the past 10 years, really going back to the financial crisis. And there's a lot of particularly with individual accounts, there are a lot of rules that money managers have to abide by. If you're a qualified investor, and you know, then you can do a lot more things than if you're just an ordinary investor. But that is really just going to be a question you're going to have to ask the company you do business with if they do allow you that kind of flexibility. Generally, I would say that you'd have more flexibility outside of those types of accounts. They tend to have a lot more rules attached than an ordinary trading account would.
Yeah, absolutely. You know, we have a couple questions here asking what the website is for the order. It should be on your screen right now. I also, per a request from one of our listeners, I put the link in the chat box, so you should be able to see it as a clickable link. Again, though, if you'd like to take us up on this offer, make sure when you order, you use that special 500 code. It's just the way we track you to make sure that you get, because again, we're only really offering that to those of you on this call and those of you who registered for this call. So which we don't have, we haven't invited everyone to the call. Not everyone registered, obviously. So you need to use that code to make sure that, and through that website to make sure that you get all those bonuses we mentioned. You know, the forever guarantee, the lower price, of course, and you know, the guarantee about the annual subscription, 60-day free trial, etc. So I did put that link in the chat box on your screen. We have another question. Will there be a transcript for this webinar? There will not be a written transcript for the webinar, but we will be providing you with a link to the recorded version of the webinar probably sometime tomorrow. And I'm going to go ahead and instruct our team to send you a copy of the slide presentation in PDF format as well. So you know, I think you can follow along some of our main points for that and then listen along if you like as well. So we'll send both of those things to you. In addition, I would point out that if you click that web page that I put up there, the one pigversusbear.com 2018 volatility smile that you see on your screen right now, that actually covers some of the points, some, but definitely not all of the points we covered on today's webinar. It's kind of a detailed open letter that Roger and I put together towards the end of last year and updated earlier this, well, not earlier this month. There's nothing earlier than the 1st, right? But,
late last month.
Last month, right, in terms of the charts and things. But some of the points are on that web page as well. And then we have a question here about what pig versus bear performance is. We actually do have that up on the website. You can check out the pig versus bear performance for all of our open and closed trades as well on our website. So that kind of answer your question there. I'd say generally speaking, we started pig versus bear 3 years ago, roughly. We started a beta test in March of 2015. So it's March of 2018. So I think our 3-year anniversary is maybe a week from now. Generally speaking, like most trading services, we do best when the market's pretty volatile. We did really well in the service, especially trading oil on the short side from 2015 all the way up through early 2016, mid 2016. Periods of very low volatility provide less opportunities and upside for us. So returns from the first half in particular, up through September of last year were not as good. Since then, though, we've had quite a few big winners, including trades I showed you in AMJ, the Larian. XLF has also been good to us. And we also had a long trade we had a short trade in oil in the summer of last year and a long trade in a leveraged ETF on oil from late September, I believe, through November of last year. We've also had some successful trades on individual energy stocks and MLPs. We've had the successful short trade on utilities. So as we start to get more volatility, particularly over the last couple of months, we've had a lot of good trades. And one of the reasons we wanted to host this, the main reason, in fact, we wanted to host this webinar today is that pretty much nothing beats a buy and hold type strategy with an ETF or passive index when you get years like 2017, but you don't get very many years like 2017.
They're the exception.
It's the exception rather than the rule. It's hard to beat an investment strategy in that kind of a market. In a choppy market, such as we've seen so far this year, and I believe we're likely to see through the end of this bear market, and then during the bear market itself, I would put up trading strategies against everything. It's shocking to me. I mean, when I first got in this business, I mean, everybody was talking about hedge funds and how like alternative investing was the way to go. And that was because markets were a lot more volatile back then. And then now, what do you hear? You hear the death of hedge funds and passive indexing is taking over the world and ETFs are taking over the world. And when everybody's focused on one thing, that usually means that trend is about to end. Just ask the people who were betting on ever lower volatility towards the end of last year, right? That trade blew up writ large this year. So I mean, I think that's typically that's typically what we look for. As far as, we had a couple comments from the reader who was asking about the options for income. Says that it's okay to do it in an IRA, and covered calls you can do in an IRA. I actually do know that covered calls are possible in an IRA. Mm-hmm. With puts, you have to have it covered, so you have to have the put money up. So in other words, if you sell a put on a stock that's trading at 50, put option contracts generally carry 100 shares. You have to have enough money in your account to be able to buy those 100 shares. Again, I mean, this is just what a reader's posted in.
Well, that's like sorry.
Go ahead, Roger. No, I was going to say, I know about the covered call part. I didn't know about the rules on the put part.
Yeah, I mean, the selling puts can be interesting if you're trying to accumulate a particular stock as well. I was just going to say, as a strategy for kind of getting into a position over a period of time, if you're kind of uncertain about the direction. So I mean and you can realize income while you're waiting to get in, and basically you would just set you would sell a put that was in the money to garner the income, and the worst that you would do would then have to buy this, have that stock put to you at that price. I'm assuming the reader knows that, but that's how I would go about it. Rather than thinking of it in terms of augmenting. I mean, you definitely in a market like this, I suppose selling calls against your say your utility positions would be a relatively conservative thing to do, because worst case is the stock gets called away from you at a better price. Best case is you get some income and while your stocks are coming down. I think the main thing you would just need to do is just be very mindful of what you're doing and keep up with things. So a one-day event, because in a market like this, there's a lot of volatility. So you could get blown out of position even if you have a fairly conservative approach.
Yeah, I would also say to this particular listener, I would say that Pig versus bear, the service we're talking about today, I mean, it is more of a trading service. We do some put sales, and we actually have done, I believe, a while back, a covered call as well. So, you know, we certainly have that type of strategy in there. I would say that that's probably not the focus. We're not really, pig versus bear isn't necessarily about generating income from a retirement perspective. You know, we do have services that are more oriented towards generating retirement income. Roger has one, which is more on buying stocks for long-term income. And also in our deep dive investing service, which is a fairly new service, you know, we do a little bit more of that. In fact, we're soon going to be rolling out what we call an enhanced income portfolio, which is basically just going to be stocks we like and using options to take those stocks and just turbocharge the income. So that's going to mainly be selling puts on stocks that we like at strike prices that we believe would represent a good place to buy that stock. And it's also going to be using things like covered calls. And it's going to be a little longer term type of recommendation. That might be more appropriate if you're looking for that type of retirement income in an IRA than pig versus bear. I mean, I probably shouldn't sort of try to talk you out of pig versus bear on the webinar about pig versus bear, but I want to make sure that if that's what you're looking for, more retirement income type strategies, you know, deep dive investing is probably might be a better service for you. You know, I don't have the website. I'm not even sure if it's open to new readers now, but I'll tell you what, give Sherry a call using that toll-free number on your screen, that 877-302-0749. Just give her a call if you'd like to check out deep dive investing. Tell her you were on today's webinar and that I sent you. My name's Elliot, if you forgot, and she'll tell you what the best offer we have out there now. I know we were running a little offer on that last week, but I think we can probably extend that to you. If you'd like to check it out and you were on this call, just tell her I sent you. Hopefully she won't yell at me for doing that. You know, that would be, you could check that out if you like. Just call that number on your screen. The next question is there a recommended trading platform that you guys prefer? I would say two things. You know, full disclosure, we use Bloomberg, which is kind of a professional service. It's frankly very expensive, but it's very good. Has a lot of fundamental information on it, as well as technical type information, studies. It's what's used in most institutions, hedge funds, etc. Roger and I are both addicted to our Bloombergs and pretty much carry it with us everywhere we go, either on our phones or on our laptops or on our desktop computers. So that's what we use in terms of a platform to follow and recommend these stocks. I would say, though, that we do not, the kinds of trades we do in pig versus bear, you probably don't need a complicated trading platform. We're not trading futures, you know, we're not trading, the types of trades we do are relatively simple to follow. In fact, oftentimes, I'm not going to tell you all the time because that wouldn't be true, but oftentimes we'll recommend something like buy this option at using a good until cancel limit order at, you know, $1.25 each. Okay, so that just what that means is you would go to your broker website, whoever your broker is. Your normal discount broker is fine. Doesn't even have to have a fancy website or online charting, real time, anything like that. And you can type in, you know, this option will tell you the symbol, you know, and you know, buy, you know, 10 contracts of the option at a price of $1.25, good till cancel, limit order. And we explain in the service exactly what that means, but basically it just means that the limit order just means that your broker will automatically buy that option for you if it trades at a price of $1.25 or better. So that means that, you know, you could do that over the weekend even, or, you know, overnight after the market closes. And then the next morning, maybe you get up, you could walk out for breakfast, you can be playing golf, whatever, right? Be asleep. You know, and your broker will still execute it for you automatically. So we do a lot of trades like that, are very not complicated. In fact, I think some people try to get too complicated with trading, and they end up making it so complicated it's really difficult to make money that way. We really like to keep it simple. If you don't like to trade options, not a problem. We offer usually an ETF or stock alternative. If you only like to trade options, in many cases we'll offer an options alternative to our stock trades. We don't really recommend a particular trading platform, but I think you can do it on almost any online discount broker you might have.
Right. I think so. Interactive brokers, you know.
Yeah, I've used them in the past, and you know, they have a pretty good platform, I think. And you know, and many of you, I know that many of our customers use more sophisticated trading platforms like that. The Interactive Brokers has a lot of add-on packages you can get, but I don't think you necessarily need that for this service. Looks like we got a few more questions here. Let's see. I've enjoyed listening to the webinar. Unfortunately, I don't have the video. Not sure why. Yeah, I'm not sure why either. Sometimes I mean, Zoom has been, which is what we're using to host this webinar, has been very good, but sometimes there are technical problems. But I would say that you will soon have the video because we're going to send it to you probably by tomorrow morning, along with a copy of the slides. So I'm sorry about that, but and I'm glad you enjoyed it, and we'll have the video and the slides to you probably as soon as they're available, probably by you know, first thing tomorrow morning. Let's see, next question we have here. The reader that was asking about long-term income says he already subscribes to you, Roger. So
thank you.
Yes.
Much appreciated.
And he says, thanks a lot. You guys are honest and appreciate it. Well, thank you. Thank you very much for saying that. We certainly try to be, and we really enjoy doing these webinars, and we're really excited about the trading opportunity at this stage of the market and economic cycle. I don't see any more questions in the queue right now. It looks like we've covered all of them. If you have any more questions, you can type it in really quickly. Otherwise, on our website for Pig versus Bear, we do have, if you sign us up for the trial, we do actually have a dedicated email address. That you can send emails to that will it goes pretty much directly to us, so we can answer any questions you might have after the case. And we'll give you another email address in a follow-up when we send you the link to the slides and the presentation. We'll send you another email address you can use to ask any questions that might crop up as time goes on. And then we have a couple more questions just came in. How often do updates come out? So what we do is we do a written update every week. Usually comes out early in the week on Monday. Once per month, we do a detailed webinar like this, where Roger and I go through every trade in the service and some trades we're looking at. We also usually spend a lot of time on the macro picture for some of the markets we like to trade most often, which would include the broader stock market, oil, etc., and also energy stocks and MLPs. And Roger usually likes to talk about utilities a little bit, etc. So that's once a month, and that does include a question and answer, which is subscriber only. And then the alerts come out fairly frequently. It varies, of course, depending on trading opportunities, but I would say you can probably expect, on the order of 5 to 7 alerts per month, in addition to those weekly updates as trades come available. You know, last month we actually, even though it's a short month, I think we had more like 10 last month, and the month before was another heavy month because we were taking profits on a lot of the options that, as I explained to you, as we rolled up those contracts. But you know, you can depend on the once a week and then the once a month online webinar like this. The week we host the online webinar, we do not do a written update, but every other week we do an update. And then the same listener asks, how quickly do you need to put in trades to be effective? It does vary. We try to let you know as far ahead of time as possible. So oftentimes we're going to enter trades via a limit order, and then some days it may be days or even a week or more before that limit order gets executed. So you could literally log on to the service, once a week and set up your orders and kind of forget about them in many cases. Other times we'll send out the order. during the trading day, if something crops up in the middle of the trading day. They're not particularly time sensitive overall. I can't remember very many cases where we've recommended a trade and then you've had like an hour or two to get in and then it's moved away from us.
Yeah.
Typically, you'll have sort of 24 hours or more to get in, 2 trading days or so to get in before it really takes off. There are exceptions to that, but usually you don't need to sit in front of your computer screen. A lot of trades are entered or exited via limit orders, and typically they're not so fast moving that you can't jump in, or you can't, if you see it the next morning, you're probably still going to be able to get in, or even the morning after that. I would say one more thing about that. We don't assume you got in, especially on options trades. What we do is we look on our Bloomberg terminal, we look at the actual trade data, and we say, okay, let's say we recommended getting into a stock under $50 a share, and we recommended it was trading at 48, and by the next afternoon it's trading at 53. We look at the amount of volume that traded under our buy price over the course of several hours after the recommendation goes out. And we take the average trading price within our trading limits over that period of time and use that for our official hypothetical portfolio. So if you see an alert come out from us and it says buy the stock under 50 and it's trading at 51, don't do anything, and don't think that we're going to like claim that we got in at 50 when it's trading at 51. We always use that volume weighted average price. If we think it's worth chasing it a little bit, we'll come out with a new alert saying, okay, buy it up to 52. So hopefully that covers that question.
I think so.
And I don't see any more questions in the queue. I think we got everything. Thanks for all those questions. I think that's one of the more question-filled webinars we've done lately. We really appreciate that. It certainly makes our job easier. Thank you very much for attending today. We hope we can welcome many of you on as trial members to Pig versus Bear over the next few days. As I said, this meeting was recorded. We will send out a copy of the recording tomorrow. Also the slides in PDF format. In case you had trouble seeing any of them, it can often be easier, of course, to read them in a PDF format. And we're really looking forward to the trading environment over the next couple of years. With that, I'm going to go ahead and close the webinar. Thanks again to everyone for attending.
Thanks, everybody.